Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In this episode, we're going to take a deep dive on dividend ETFs. We're going to walk through what I think are three of the best dividend ETFs. And if you're a longtime viewer, you may be saying, Rob, I thought you hated dividends. No, I love dividends, but they're not my North Star. I think for all investors, frankly, our North Star should be total return. And that's true even if you're like me, near or in retirement. But I do think a dividend ETF or mutual fund version can be an important part of a portfolio in some cases. So here's what we're going to do today. We're going to talk about first what a dividend ETF is, and just as importantly, what it ain't. I'm going to look at a couple of things that I look to evaluate dividend ETFs. Then I'm going to walk through three of what I think are pretty good dividend ETFs and why. We're going to compare the three. Then we're going to look at one that I think ain't so good, and why it can really help us understand both the pros and cons of dividends. And then finally, we're going to look at how you might incorporate a dividend ETF or mutual fund in your portfolio, why you might do it, how it would affect your portfolio. As you know, I'm going to give you very specifics. We're going to be using M1 Finance. We're going to be using Morningstar, Portfolio Visualizer. I got all the tools ready. So that's what we're going to do. So as I like to say, enough chit chat, let's get right to it. So the first thing, a dividend ETF or mutual fund is primarily just a stock fund that pays higher than average dividends. Keep in mind that stock ETFs and mutual funds, I think all of them pay some kind of dividend. I'm not aware of one that pays literally no yield at all. Maybe they're out there, but even an S&P 500 index today, even in our low yield world, pays about 1.2, 1.3% yield. And growth funds like the QQQ or VUG, a Vanguard growth fund, they pay a dividend yield as well. It's well below 1%, but they still pay a dividend. So what we're talking about are funds that pay a greater than average yield. That's generally what a dividend ETF is. Now, having said that, some kinds of funds tend to get excluded from what you might call a dividend ETF. I think the thing that comes to mind first would be REITs. They certainly pay high yields, but they're generally excluded when you talk about dividend ETFs. They're special in a number of ways, and in fact, many of the dividend indexes specifically exclude REITs, although not all of them do. So we're basically talking about stock funds that pay higher than average dividend yields. Now, once you get down to that universe of funds, what should you look at in evaluating them? And I look at a number of things. Of course, I do look at the yield. Oddly enough, I look at it for funds that have yields that are frankly too high. I'm more concerned about a yield that's too high than I am a yield that's too low. I think when you get to 3x the average yield or higher, boy, that should be a red flag. And we're going to look at an example of that. You often find yourself in funds that are going to, in my view, significantly underperform a basic plain old S&P 500 index fund. And I see no reason to do that just for a higher yield. I also want to look at the growth of the dividends. It's one thing for a company to pay a high dividend yield. I'm actually more interested in how they're growing their dividend each year. And there are some funds, we're going to look at them, that actually focus on dividend growth from year to year. The third thing I look at is the stability of a dividend. This is certainly true when I'm evaluating individual stocks. And I think it's important when looking at the portfolio inside a dividend ETF. Again, you may have a high yielding company, but it may be paying out a large percentage of its profits each year just to maintain that dividend. And that would call into question just how stable the future dividends of that company are. So you want to look at dividend stability as well. I also like to look at fundamental factors, the things like just valuations. What's the price to earnings ratio of the fund, or the price to book ratio of the fund? And in fact, to me, that's actually why some of these funds might be worth considering, not actually the dividend yield, but the lower valuations as compared to the very lofty prices we see, say, in an S&P 500 index right now. Again, we'll take a look at examples of all of these things. And the other thing that I think is important, this is true no matter what kind of funds you're investing in, it's the expense ratio. We want to keep our expenses as low as possible. And the funds we're going to look at today, at least the ones that I like, have extremely low expense ratios. So having said all of that, we're going to take a look at 3 funds that I like. Now, below this video, in the first comment, I'm going to link to an article I've published that goes with this video. It's on my site, robberger.com. It actually includes more ETFs than what we're covering in this video, and it has links to all kinds of information about each of them. So I encourage you to check that out if you want more information. So with that, let's take a look at number 1. And I don't think this is going to surprise many of you. I've got it on the screen now. This is the Schwab U.S. Dividend Equity ETF. The ticker symbol is SCHD. It's one that many of you have written into me about. You can see from the screen right down here, its expense ratio is just 6 basis points. Now, this fund, it's an index fund. It tracks the Dow Jones U.S. Dividend 100 Index. You can see it has a trailing 12-month yield of 2.82%. So that's just over about two times the S&P 500 yield, which I think right now is around 1.2, 1.3. Now, one of the criteria for a company to be included in this index is that it has to have 10 consecutive years of dividends. Now, not increasing dividends, just 10 consecutive years of dividends. That's still pretty significant. But the thing that I like about this fund is that there's some fundamental analysis that goes on. And you can't just have a reasonable dividend yield and make the cut. This index looks at things like return on equity, free cash flow to debt, and it does look at growth rates, specifically a company's 5-year dividend growth rate. So it looks at all of those things. We can take a quick look at its portfolio. We can see that it is a value fund. And again, remember, you got value, growth, and then in the middle, blend or core. And if we look at some of the some of the value measures, you see price to earnings. This is a forward PE. It's under 15. I think its trailing 12-month PE is closer to 19, but still well below the valuation, say, in a total market fund or an S&P 500 index. Its price to book is lower, price to sales as well. And if we scroll down, we can kind of get a glimpse of some of its holdings. Texas Instrument, Home Depot, IBM's in there, Verizon, Pepsi, Coca-Cola, obviously companies that we're all familiar with. So I think this fund is a really solid fund. It's my number 1 dividend ETF. And if we take a quick look, we can look at its performance. Let's see if I've got the right portfolio visualizer screen. Yeah. So what I'm doing is comparing the Schwab fund, which is here, to SPY, which is an S&P 500 ETF. The data goes back only about 10 years. That's because that's the limit on the Schwab fund. And to my surprise, frankly, Schwab held up nicely. In fact, it didn't outperform the S&P 500, but that shouldn't surprise us. The last 10 years, growth has clobbered value. And so because the S&P is sort of a mix of both, where Schwab is a value fund, I know people think of it as a dividend ETF. It is. I like to think of it, though, more as a value fund. It's both, but that's really my focus, not so much the dividend yield, but the valuations of the companies that are in the index. But because growth has so outperformed value, the S&P 500 has certainly outperformed the Schwab fund, by roughly, if we look at the compound annual growth rate, roughly by about 1%. And the standard deviation, which gives us a sense of a fund's volatility, is neck and neck between the two. And we can scroll down further and we can see the income. Of course, the Schwab fund has significantly more income each year, and that makes sense. It's got a higher dividend yield. Again, that's not so much my focus, and that may seem odd. This is a video on dividend ETFs. To me, again, total return is the key. And so that may raise the question, well then, if total return is what you focus on, Rob, you might ask me, then it's a no-brainer. You stick with the S&P 500. Well, I think there could be an argument for actually including Schwab in a portfolio. We'll come back to that at the end of the video. All right, the second ETF I want to look at is from Vanguard. It's the Vanguard Dividend Appreciation ETF. and its symbol is VIG. And this takes a slightly different approach. It tracks the S&P U.S. Dividend Growers Index. And to make the cut, the company's got to have 10 consecutive years of dividend growth. 10 consecutive years of dividend growth. You can see its trailing 12-month yield is 1.48. We see that right here. Its expense ratio is just 6 basis points. And if we take a quick look at its portfolio, we can see it's actually registered by Morningstar as a blend fund. It's right on the line, the border of value. But we can see, again, this is forward PE, but it's significantly higher. It's 20, almost 21 as compared to the Schwab fund. And if we scroll down to the top 10 holdings, we can see it adds some holdings we didn't see before with the Schwab fund, like Microsoft, and Chase, and there's Walmart in there, obviously companies that we're very familiar with. And we can actually now add this to Portfolio Visualizer just to sort of compare everything. So we'll put VIG right here, and we'll analyze it. We've got the same time period. That's always important to check. So roughly 10 years. And if we scroll down, we can see it actually, and this was surprising to me, it underperforms Schwab. And it's surprising to me because Schwab tilts more towards value. The Vanguard fund tilts more towards the blend, so that's getting us, in the direction of growth. And given how growth has outperformed value over the last 10 years, I actually expected this fund to not outperform the S&P 500 over the last decade, but to outperform Schwab. And you can see that it hasn't. Now, my takeaway from that is not necessarily that Schwab is a better fund than Vanguard's fund. I mean, 10 years is, I think, a reasonable time, but it's not super long. I'd prefer to see 20 or 30 years of data. And more importantly, I'd prefer to see data through multiple economic cycles. So I still think this is a fund worth considering. Having said that, it has significantly underperformed, at least compared to the Schwab fund over the last 10 years. All right. The third and final fund that I like is the SPDR S&P Dividend ETF. Now, you've probably heard of the Dividend Aristocrats. Those are companies that have increased their dividend consecutively each year for the last 25 years. Now, at the moment, there are about 65 companies, I believe, that meet that standard. This fund is similar, except that they cut it off at 20 years. In order for a company to make the cut, and this fund tracks the S&P High Yield Dividend Aristocrats Index, in order to make the cut, they have to have 20 consecutive years of increasing dividends each year. Now here you might be saying, well, Rob, what's the deal? I mean, everyone knows Dividend Aristocrats is 25 years. Why are they shortchanging us and accepting companies that have only increased their dividend for 2 decades? Well, I suspect it's so they can include more companies in the index. If you look at this fund in Morningstar, and let's do that, here we are, and we scoot over to the portfolio, we can see if we scroll all the way down, here we go, there are 112 holdings in this fund. Again, the Dividend Aristocrats, about 65. So there's roughly, 50 or so additional companies in this index that would not be there if they stuck to the 25-year requirement. So still, these are companies that have had a remarkable run, and you can look at them. These are all names that we recognize. This one, by the way, includes REITs. I note Realty Income down here. Their ticker is O, I believe, and has been an excellent REIT over the last couple of decades. Really phenomenal, I would say. But so that's how this fund is built. And if we put it in portfolio, and actually before we do that, let me jump over to the quote page for just a second. We'll see its dividend yields around 2.6, I believe. Yep, 2.6 yield. It does have a slightly higher expense ratio, and frankly higher than I would like, but at 35 basis points, it's not high enough for me to exclude it. And so if we're going to come in here, since we can only look at 3 portfolios at one time. We're going to get rid of the S&P 500 and put an SDY instead. We'll analyze it again, check our time frame, same time frame, roughly 10 years. And we can see that the SPDR dividend actually now is the lowest performing. We've kind of worked our way down. Of course, that makes sense in part since, you know, of the three, Schwab is my favorite, although that's not just because of the past 10 years. Still, the dividend aristocrats, I'll call it the modified dividend aristocrats, since it's just 20 years of increasing dividends, came in, I guess you say, came in last place, right? And that's just the way it is. And its standard deviation is, you know, roughly in line with the funds we're looking at. So in other words, its volatility is similar. The thing that gets kind of interesting, if you come down to the portfolio income, one thing I want to point out, these funds sometimes reduce their income. Now, the thing that I find interesting about this is blue is the Schwab fund, and you'll notice that it's pretty consistent with its dividends. I mean, it hasn't had a decreasing year. Of course, 2021 we're not finished with yet, so we'll see how that plays out. But look at the dividend aristocrats. In 2016, it took a nosedive, took another nosedive in 2018. We'll see what happens in 2021. Now, if you compare that to the Vanguard dividend appreciation, it looks to have increased pretty much every year by a little bit. But I found that interesting that the Dividend Aristocrats Fund had such a portfolio income that wasn't as, I guess, stable or consistent as Schwab's. That really surprised me, but there is the data. So those are, I think, three reasonable dividend ETFs to consider. As I've told you, I like Schwab the best, but those are three that I think are worth checking out. Now, I promised you I'd show you one that I don't like, so let me do that now. We're looking at the Global X SuperDividend U.S. ETF. Its ticker is DIV, so that's not hard to remember. Check out this yield, 5.61%. That's pretty juicy. Expense ratio, you know, again, on the high side for index funds, 45 basis points. This tracks the Index SuperDividend U.S. Low Volatility Index. Yes, that's a mouthful. Look, this index looks at dividend histories for the last 12 months and projected 12 months going forward. Interestingly enough, it excludes companies with yields below 1%. It also excludes companies with yields above 20%. And that's how it, among other things, it of course looks at other factors, but that's at a high level how it creates its index, and this ETF tracks that. Now, I want to show you what this looks like as compared to some of the funds we've looked at before. So there's the div, that's the one that I'm not really a fan of, and we're going to compare it to the Schwab fund, and we're going to compare it to the S&P 500, and I've run the numbers. Now, it only goes back to January 2014, so that's what, 6, 7 years, 8 years. That's what we have. It's the best I can do, but there it is. And when we look first at performance, we can see that div significantly underperforms both the Schwab fund and the S&P 500. But what's even, I think, more damning, look at its standard deviation. It's risky. It had a max drawdown of 45%. Well above, more than twice the drawdown of the other two funds, and look at its worst year, minus 23%. So you get low returns and you get high volatility. It's like I'm looking for the opposite of that. So this is an example where, you know, you've got to be careful. Just because a fund or an investment has a high dividend yield, frankly, that should be a warning to us, not an invitation to come in and enjoy the high dividend. It should be like, okay, what's wrong with this investment that it can pay a dividend yield 4 or 5 times the market average? Now, the other interesting thing about this fund, when we look at yields and we come down to income, the blue is the dividend, the SuperDividend U.S. ETF, and you can see it's not a particularly stable source of income. Yeah, it went up in 2015, but then it went down in 2016, down again in 2017. It made a little progress 2 years running, and then just fell again in 2020. So that's something you really need to be careful with. Just because you have a high starting yield, it doesn't make it a good investment. So there's an example of one that I'm not a fan of. Now, again, in the article I've linked to below this video, I cover a couple others I'm not a particular fan of as well. Now, all right, having said all of that, how should we think about a dividend ETF? Should we include it in our portfolio? What would be the reasons to do it? What would not be the reasons to do it? And generally, what I think of when I see a Schwab fund, I don't see a dividend ETF. As I mentioned earlier, what I see is a valuation, a value fund, a fund that has valuations, whether you look at price to earnings, price to book, price to sales, that are significantly below the market as measured by either the S&P 500 or perhaps a total market index. And we all know valuations are extremely high right now. So I think the argument in favor of a dividend ETF would be wanting to bring the overall valuation of our stock portfolio down some. Now, here's the trick. Just because you bring your portfolio's valuations down through, say, adding, for example, Schwab, doesn't mean you'll outperform the market over the next year, 5 years, or 10 years. We don't know what the future holds. Having said that, growth funds have significantly outperformed value funds. Interest rates are at all-time lows. I think as they rise, and I believe they will, I just don't know when, I think we'll see a rotation from growth into value. If I had to guess, I think value funds will outperform growth funds over the next 10 years. I may be wrong. That's the thing you need to keep in mind. I may be very wrong. But I know a lot of people are concerned about valuations, and so adding the right kind of dividend ETF fund to a portfolio could bring down your overall valuations a bit. And again, will it outperform? I don't know, but if I were going to place a 50-50 bet, I would say that it would over the next 10 years. So what would such a portfolio look like? Well, let me show you. We're going to move over to M1 Finance. I'll link to this portfolio below the video, but what I've done is I've simply taken a 3-fund portfolio, so that's the Vanguard Total Stock Market Index, Vanguard International Stock Index, Vanguard Bonds, and I've added the Schwab Fund. Now, these percentages aren't set in stone. Obviously, you can make them whatever you want. It's an 80-20 portfolio. By that, I mean 80% are in stocks and 20% are in this bond fund. I've taken a little out of the international fund, a little out of the total stock market U.S. fund, and I've added it to Schwab. And it brings our yield to 2%. I can tell you that in the 3-fund portfolio, and I've done a video on this in the past, the yield was about 1.8%. So it's not going to significantly increase your yield, although it's going to increase it by more than 10%. It's also not going to significantly reduce, say, the overall PE of your portfolio, but it will reduce it some. Obviously, you could change these percentages based on whatever you wanted in terms of how much you wanted the Schwab fund to affect your overall portfolio. I would say this, in making this decision, I think the most important factor is this. Whatever you decide, whether to include Schwab or some other dividend ETF or not, can you stick to whatever portfolio you have for at least the next 10 years? Even if, for example, Schwab underperforms the market. Yeah, Rob might be wrong. You might email me 10 years from now and say, Rob, you blew that one. I say, yeah, I get it wrong all the time. Can you stick to whatever you choose? Here's the deal. More investors lose money jumping from one reasonable allocation over to another reasonable allocation. We can come up with dozens and dozens of reasonable asset allocations. The key is to stick to the one you pick. I think the one I've just shown you that includes Schwab, adding it to the 3-fund portfolio, is a perfectly reasonable allocation and great for long-term investors. The question, though, that you have to ask for yourself is, can you stick to this or whatever asset allocation you have for, in my view, at least 10 years. Now, at the moment, I mentioned I don't have Schwab. I am considering adding some Schwab to my portfolio, the Schwab U.S. Dividend Equity ETF, but I'm very slow to make these decisions. I don't just jump into them. Back in the day, I did have a portfolio that tilted towards value. This is going back, almost 30 years. More recently, I've tried to simplify things, and so right now my portfolio, for the most part, is right smack dab in the middle. So these are decisions I make slowly. Now, having said all of that, let me show you what this would look like. So I put together two portfolios. The first one here, portfolio one, is just your basic Bogleheads 3-fund portfolio. And then number two is the portfolio I just showed you in M1 Finance that adds the Schwab Dividend ETF. And when we analyze it, this goes back to 2012, so roughly 10 years. Here are the two portfolios. To my surprise, adding Schwab actually increased the total balance at the end. Now, didn't increase it by a lot. We're talking about what? 20 basis points in compound annual growth rate difference. Although it actually has a somewhat lower standard deviation. The reason I was surprised at this is because, as we looked at before, the S&P 500 actually outperformed Schwab over the last decade. But when you put it into a 3-fund portfolio, and it uses total stock market, not the S&P 500, again, those two are very, very similar, it actually outperformed by a little bit. I wouldn't read too much into that. Basically, I look at this and say it's a tie. But I was actually impressed that it was a tie. I thought the 3-fund portfolio would win out. It did not. And if we go down, and I think I've included income, yeah, you can see that the red is the portfolio that includes Schwab. It pays, as we would expect, a slightly higher yield, and you can see that in the income there. So I know I've thrown a lot at you in this video, and I'll do more videos in the future on dividend investing. I am perfectly fine with a dividend ETF or mutual fund. My focus, though, isn't so much on the yield. It's more on tilting a portfolio towards value. I think the 3 funds that we looked at all do that in different ways, and it's important for you to understand that. I've walked through the different ways. There's more information on the website. Again, a link below this video. But my favorite in looking at them, frankly, is Schwab. I know that's a lot of you have invested in Schwab. It's actually a pretty good ETF, I think. And if you're wanting to lower the overall valuations of your portfolio, I think it's worth considering. So hope that's helpful. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.